news, but it may have a barb on the end of it. I just remember when this happened in the year 2000, I did take a company public then very successfully, but we took it public with, I think, $60 million in equity and $120 million in 13.75% junk bonds. The idea being when the price rose, we'd do a secondary round and take out all the junk debt. Only I missed it by 24 hours. We literally had the sign off. We were ready to punch the button on the secondary offering, and it was the day that you woke up to a sea of red on the screen. And it was not possible. So we struggled with that 13.75% debt. Don't want to see that happen again. So what's up?
That's rough. And I'll preface this all by saying, right, we're in a completely different sector of investment in terms of stage of companies, right? And early stage venture is so far disconnected from the public markets. It actually more closely resembles real estate in terms of how real estate is related to public markets. There is very little correlation between the two, primarily because how long companies stay public, how long they wait before raising future money varies. So the effect at this macro level with the public markets doesn't always trickle down to private companies and super early stage VC investments. So my comment earlier about it being terrifying is almost thinking of the two as separate entities, right? Like whatever's going on in public markets now is nuts to some degree, valuations that we're seeing, but we're seeing a separate but similar thing with just a lot of dry powder, which means a lot of capital in venture firms and others that has yet to be deployed, that needs to be deployed within a specific time period. And the ability for firms like ours to find companies to invest in is also limited. And so what we're seeing is venture firms and other investors putting a lot of money into companies that A, might not need that much money, or B, they're going to have to find other companies to invest in that might not deserve the money just because they have to deploy it quickly. So that was a terrifying aspect that I mentioned in terms of private markets overall, just too much capital looking for too few companies, but also a good problem to have if you're an early stage founder, because the ability to raise is easier. And I think it's easier than it has been over the past few years. So I'll pause there, but hope that comment made sense, Gary.
Yeah, no, absolutely. So, I mean, just from what you've been looking at, so it has your number of closings gone up dramatically in the past 2 or 3 quarters. How are you looking at this and participating in this market?
Yeah, and so for us, we had a different view on it. So just for the benefit of everyone on the call, right? So we invested primarily in Sacramento as a region, and our fund has grown to about 110 million under management, and so we've had to expand beyond that. So we opened an office in Austin, Texas, and we also look at deals opportunistically. So in terms of what we've been looking at in the past, right, is if we just take Sacramento as an example, one of the key issues for many companies that get started here is lack of access to funding. And so, excuse me, that's primarily why we looked at Sacramento. It's that local companies don't always have access to venture funding like the Bay Area companies or other hotspots might. So taking that further into our strategy now is many of our current companies, we're seeing that they might have cash shortfalls or issues going forward. So what we said as a fund is, hey, we're just going to stop investing for a while and reserve our capital in case our existing companies need money. And so that became our strategy. And that was a strategy for a lot of, I'd say, early venture funds or first or second time funds. Is let's make sure we can see these companies through the economic downturn. That was our focus for probably the first 6 months of the pandemic leading into Q4 of last year. And then that has since somewhat changed. So we got probably 3 or 4 deals that we were wrapping up between then and now. And then just reserving the rest of capital for follow on. I think the uncertainty in the markets is causing us to just save more money for our existing portfolio than we would have before.
So, I mean, interesting you have an Austin, Texas office. I guess I missed that, but how do you compare Austin and Sacramento? At one time, I think it was Jack Crawford just looked at some data, and the number of investments, the total dollar investments in Austin was like 6 or 7 times what was going in Sacramento, even though, geographically about the same population and an association with a big university, University of Texas there. Is that still the case? Is still Austin a hot market compared to Sacramento, or have we come up?
So one of our partners is based there, went to UT Austin. Me and our founder, Lokesh, went to Cal and are from here. So this is me. I'm having a very tough time answering this in an unbiased manner because go Bears. But Austin is somewhat aspirational for where Sacramento could be as a large city that is the center of a big state and a massive economy in terms of being a capital city. And they are probably 10 or 15 years ahead of us in terms of where companies and tech is overall. And I think the GSAC, like the Greater Sacramento Economic Council, did a little mission to Austin with a lot of important folks from Sacramento to pretty much compare the two. And this is a few years ago, I think, 4 or 5 years ago. And what they found is like, there's so much resemblance between the two cities. They're just having a small head start on us. So long way to answer that. I think we are on that road for sure. But they've attracted a lot more large companies to come and build out their offices there. I think Samsung announced like a 10,000 person campus in Austin. The US Army is having a massive, presence there. And that's true of a lot of big companies. And so I think if we can start to do that at that scale, it'll make a huge difference. I think we have started on that scale. So I think Sacramento is very similar to Austin. I just do think they're just a little farther ahead in terms of having a head start, but we're on the right track to get there.
Well, that's great. And have we seen much interest in corporates offering to open, campuses here? You mentioned it, and I don't know whether there's anything in the offing. Haven't heard much about corporates having much of a presence here.
Yeah, and it hasn't happened yet to the same magnitude as it has elsewhere. But I know the city is doing a good job of trying to attract at least startups or venture-backed startups to come here, and that's through various economic incentives and the like. So we're seeing it on the early end. So we're seeing Bay Area companies move some operations or start satellite offices here in Sac, which is awesome, right? And that's hopefully going to grow into something much bigger. So that's already happening. The city of Sacramento or other economic development groups are giving them, cash or like services to come and open offices here. It's lower cost of living. It's easier access to being in the Valley. That's happening. I think on the larger scale, there was a lot of stuff around, Amazon HQ2 and stuff that I think we'll iterate and find a way to attract them here. I don't think that's happened yet, but at least at the earlier stage, it has started to happen. So you're seeing Series A, Series B companies start to build out some offices here with some core job functions, which has been good.
Well, that's interesting. So I guess this might be part of the Zoom-based migration out of the Bay Area. People discovering they didn't have to be making that trek into Silicon Valley every day. So that would be an interesting outcome for the area. And what's your view of CleanTech companies right now? Are you seeing a lot more opportunities? Obviously, that's what we focus on, is the CleanTech sector. But do you think there are some good things happening here in CleanTech that are coming through the pipeline?
Yeah. So Moneta as a fund, right, in terms of our Fund 1 and Fund 2 so far, didn't have a CleanTech mandate. So for us, we looked at CleanTech deals because they were here as opposed to that being our core focus. And as we go into our next fund in the future, we're definitely thinking about whether or not CleanTech is a huge focus area for us. And that's, I think, primarily because groups like SMUD and the like are the right types of companies to innovate with. And the fact that they're here makes it a lot easier. And so there's a huge push from the city, I think, to, and you guys probably all know this, right, in terms of incentivizing clean tech investment, getting people together around that, et cetera. So we're seeing a lot happen here. It hasn't necessarily created the amount of volume in terms of deal flow yet, but I think that's just a lagging indicator of groups like SMUD, et cetera, saying that they're going to pour a bunch of money into clean tech innovation, right? So it's definitely coming, and I've seen a lot more clean tech deals than I usually would, given that I'm not out there looking for them. But that entire the volume and magnitude of it, I think, is probably going to be seen over the next 2 to 3 years. And for us to look at it is also going to become probably a focus area then.
Well, we speculated with the Origin Materials deal, the $950 million raise that they did. We're now getting noticed on NVCA lists and others, which itself tends to build momentum and attract attention. You've had the Infinium offering that seems to have had some of the same effect. Are you also detecting that we're getting on the radar screen?
Meaning like Sacramento as a whole?
Yeah.
Yeah. No, I mean, with the groups you mentioned, like I work very closely with the NVCA, and I follow all the VC funding lists, and I love seeing when Sacramento, California based company raises X, Y, or Z, that's coming with much higher frequency for sure.
Yeah.
So agreed across the board. Purely on the clean tech side, there could be more, but it's definitely increasing over the last year or two.
Well, that's great. So one of the things that we've been most pleased with is the cow seed funds, because they give that very hard to find otherwise money to develop a concept into a prototype. And, that takes away some of the concerns about innovators in our space. Are you seeing that as a good platform for building deal flow in our area? Have you had much interaction with the cow seed winners?
So we have not personally had interactions with them. I'd say generally though, this is true of clean tech, this is true of life sciences, and probably also hardware companies in terms of the ability for general investors, general VC investors to put money in that space. It's usually into very capital intensive businesses, or right, in the case of life sciences, a translational gap between ideation and commercialization. And so we would love to interact more with folks like the Cal Seeds program, for example, that are willing to fund that gap. So if there's more money put into that, it gives us better access and incentive to talk to those companies, because they're going to be closer to our investment stage once they've used that grant money, or will be willing to invest alongside that grant funding. The net dilutive effect to us is lower, and the company has more money to take care of production costs or CapEx intensive costs that we don't want to be the ones funding. So while we haven't gotten a chance to work with them, we hope more money goes into that, because it enables us to start investing earlier in these types of companies.
So what is your investment stage? You're looking beyond seed, or where do you think your sweet spot is?
Yeah, so we usually say $500,000 in recurring revenue or more. What I'll qualify that as is post product market fit, pre Series A growth. So we want to make sure that you have customers, multiple customers, not a huge issue of revenue concentration from just one customer, and you have, let's say version 2 of what you're doing before we invest, right? And that usually ends up being qualified as at least 500,000 in annualized revenue. So 40 to 50K a month or more is where we come in, and we'll invest through Series A, maybe Series B stages.
So you had done a number of medical oriented deals, and that was hot in Sacramento for a time. Is that still a hot area for you here?
Yeah, it's an interesting comment. It ties back to clean tech in some senses. our entire partner group background is in enterprise software, so nothing to do with healthcare particularly. In our first fund, we realized that there's just a lot of medical, health tech, healthcare IT deals happening in Sacramento. So it was very opportunistic that we decided to start investing in that. We got our feet wet in health tech overall and realized that we can do pretty well there. And Sacramento has a lot of that going for it. So that became a focus area. So about 20% of our fund is now invested in healthcare, maybe a little bit more than that, or healthcare IT, because it was here in SAC and there was a lot of deals around that. So we've gotten really good at it. And there's a lot of companies that are doing that. And as that applies to CleanTech, it also kind of becomes opportunistic in that we're seeing companies either starting companies in that sector here or moving companies here. So it's almost a similar analog for us that we're going to start diving deep into that in a similar way.
That's terrific
Gary, if you don't
news.
mind, I have a quick question for Sabya. So when you're going and looking at, because you looked at a lot of these medical companies, how do you kind of consider their IP? Because if you're going to do an equity investment in there, you now have a portion of their IP, which in medical companies might retain value even if their market doesn't really appear. Is there a way that you evaluate IP beyond just what their, I guess, initial business model was as part of your investment, or is it strictly on going after their business model and the ability to reach their target market?
Yeah, and at the early stage, this is what makes it difficult for non strategic investors to get into stuff like healthcare, right? Is we are not the ones to evaluate the underlying IP for a healthcare company. We're not going to know how effective it is or why it's differentiated versus someone that does just that into investing into medical devices and so on and so forth. So when I was trying to say post product market fit, for us, we identify the value of the IP and the success of the IP based on what someone's willing to pay for it in the market. Mm-hmm. So we want them to cross a certain revenue stage because that's a proxy for the value of the IP. Once that has been done, then we'll bring in subject matter experts. So within our fund, our investors include executives across a lot of places in healthcare, right? C-level or other type of executives from, Centene, Dignity Health, and so on and so forth, who can connect us to the folks to dig into that underlying IP. And we usually do that at some stage to go and value what that's worth. But it's only worth our time to do that once we know this company has crossed the threshold of product market fit. So same thing applies to CleanTech or anything in general. Is once you've identified your core customer profile, who you're selling to, et cetera, then we will go dive in and make sure that the underlying IP, everything else, checks the boxes for us.
So if I were to summarize it, it doesn't matter how cool the IP is if someone's not buying it already, right?
Yeah, and yes, that's how we would look at a deal for sure. And the flip side is, hey, we have another fund that's coming in and leading this deal, and that fund knows exactly what they're doing. They know how to very much qualify this IP, and this other company wants us to be a part of that round. We will look at it because we know that there's smart money coming into it that can do a better job of evaluating it than we can. That's less common, I'd say, but usually it's the former that you mentioned.
Well, I see some other people raising their hands, and Mark Roost has offered to introduce you to someone in the healthcare space on that. He's from Canada. I just saw that he put a question up here. What percentage of the company do you require in order to invest? So that's a whole question on valuation and where you want to be in the cap table. Do you have any guidelines you follow on that?
Sorry, you're asking me to answer that second question, Gary, right?
Well, yeah. What percentage of the company share do you require in order to invest?
That's
what Ms. Old.
Yeah, it's a bit of a sliding scale because we do invest in that post-seed through almost Series B status of companies. I'd say our core focus area is in those companies doing the $500,000 to a few million in revenue, and we're going to write a check between $1 million and a couple $1 million. And so the valuation swings pretty wildly. What I'll say is we don't have a target that goes into it. We will say that we love to have double-digit or more ownership is our usual focus. Sometimes that might mean 20, 25% onwards, but sometimes it might just mean like 10% or under, but the range is really wide. For us as a fund, we're very operationally focused, and so we spend an inordinate amount of time digging deep and working with the companies day to day, as opposed to just being financiers of these companies. And so we usually like to look for deals where we could have a much higher percentage. So specifically answer that question is, one, the more the better. Two, we always look at double digits, kind of the baseline. And if you want to give a valuation to your company, this is purely based on enterprise software companies as kind of a rule of thumb formula that I think was set by one of the large VCs out in Silicon Valley. And they pretty much said, take your annual recurring revenue, multiply it by your annualized growth rate, and multiply it by, they said 6, some constant, some number. That became their model for valuing software companies. If you're doing $1 million in revenue and you've grown 100% from the previous year, times 6 in this case, you're valued at 6 million, right? That becomes kind of a rule of thumb. And so you're raising $1 million or something, that gives you the percentage. So we have similar metrics on our end that we use to value the company. I'd say we don't have a set focus or percentage, but we want to find companies where we can own more now or later in order to justify the amount of operational effort we spend with them.
So where are you on the exit scale? Have you had some good exits in the funds now, or are you still growing companies and getting them to that level?
Yeah, so our fund one, which is I think 7 years in now, has I think already returned close to half the fund. So I think maybe 40% ish back to our investors through exits, which has been awesome. And for us, we're always looking to see if it makes sense to exit at a particular round of funding, or stay on. The issue generally is nowadays companies are staying private a lot longer. I think in the past, 20 years ago, let's say, was the average time for a company between being started and going public was like 3 or 4 years. It has now grown to 8, 9 or more. And so for a 10-year fund, it becomes tough to figure out when to take an exit because you're limited by the length of your fund. But we are seeing some pretty good exits. We've had a bunch. So that's been good. But we also have a few that are kind of on that track to possibly IPO or be those, unicorn type companies that are just going to take way longer before they exit.
And you had mentioned capital intensity as a factor that you evaluate, and a lot of clean tech companies are physical product oriented. They do require a fair amount of upfront capital, and even some investment in manufacturing equipment. Do you see your focus changing to look more at more asset intensive industries, or do you want to stay where your origins are, that's been more software oriented?
Yeah, so I mean, that strategy probably won't change, right? Is that we ourselves will not be in a position to be investing purely in the CapEx intensive type companies. If they bring someone to the table that does that, knows that, etc., that's awesome, and we'll look at it for sure. Or they're working with grant programs and the like, then we would like to be growth capital outside of production financing or investing purely in manufacturing, etc. That's just not our space specifically. We're happy to come alongside folks that do invest in that space, or when the company gets to a slightly later stage. So we did invest like an energy company some time ago, but they were doing double digits in revenue, in millions of dollars of revenue, and all of our investment was focused on growth, sales, marketing, etc., not on production. So that made it easier to jump on that, right? We get lower equity, it's lower risk, but it's our core focus area, is enabling them to grow as a business as opposed to funding development.
Great. Well, Mark Roos, you had a question on sticking with the founder and how the fund looks at that. Mark, you want to ask your question to Sabya?
Yeah, I've been getting a broader sense of what you're up to, but so the question, where did I put the question? Oh, yeah, anyway, it's sort of, I'm in hard tech. I'm in the hard asp area of clean tech. So, and I took the incubator with Gary and Tom, and where we're at is way before where you're usually interested at. But I look at, what are the reasons? And so, you don't want to jump in and have to wait 10 years for a product to go to market. But what about a product that was started 8 years ago? And what about a product that will literally take over the world, and in which you would, in which the cost of capital, I mean, the CapEx, is so low compared to everybody else, like $1 million a gigawatt hour, that everyone else is spending 3 times to 20 times that much on a battery factory. And where we've got 60 years of intensive pioneering for the inventor, 60 years of pioneering in the ceramic semiconductor industry, which is a totally different way. The ceramic roof tile factory is what we're looking, or floor tile factory is what we're looking at to make electrodes, rather than the kind of equipment that you need for a typical battery factory. So the question there's a few questions wrapped up in, or that come out of that. One question is, if the technology risk is pulled out and the market is extremely large both because it is, and because the product costs a whole lot less to make and performs several times better, it's disruptive technology. If you've got that going, and if you have, you have a lot of avenue, basically the timing is working out so that the market is ready and ripe for large scale acceptance of uptake of batteries, for instance, or solar, or replacements for neodymium motor magnets. We've got all of those. So it is a disruptive and coming out of left field kind of thing here, where it doesn't fit the normal venture capital pattern. Although one other issue is that because in the 80s, the oil industry put together a $4 or $5 billion pool and went around buying up solar companies and shutting them down, and one of them being a friend of one that was shut down without being bought up by being destroyed. It was a friend of the inventor I work with. So when we're not going to be putting ourselves in public on an IPO because the oil industry might be able to buy it, we're going to be closely held, but we're going to generate huge amounts of revenue, and exits can come from saying, okay, you want the profits from this factory because we're going to put up 156 factories around the world.
Hey, Mark, I hate to interrupt you here, but we do have a limited time.
Yeah, well, that was it. That is it.
All right.
I got it out.
I think. Oh, yeah. And if
so
there's,
let's let Sabya respond to that, please.
Okay.
So Mark, I wasn't sure what the final question was, but at some point I think I did understand, if your company does not fit in the traditional generalist VC model, what do you do, right? So if I can just respond to that part of the question, there's 2 pieces to it, right? One is what I told you, which is what I was explaining earlier, which is there are investors that are not the traditional generalist software tech VCs like us that will invest in that space. And they are the ones that usually lead those deals at the stage that you're at. So if the company's been around for 7 or 8 years, it's still developing R&D, it's still perfecting processes, et cetera, before really getting to market. Those are the folks that need to be in those deals, right? Because honestly, we just don't know what we don't know, right? So for us to dive in and say, yes, we buy what you're saying, it makes complete sense, and we understand the underlying innovative paradigm shifting tech you've built, it would be disingenuous to our own investors, right? But for us to say, hey, this company which invests purely in this material science field or this clean tech field is coming in, validated everything, and we're going to be a small part of that round. That's how we will look at it. So where I'm getting at is finding those investors, many of whom exist that are strategic, that might come from corporate venture firms of companies you work with, or just people that are investing purely in that space are the ones that need to lead those deals, and you have to find up front. And it might be a very small number, but they do exist. And then the rest of us will pile on to stuff like that because we know that they know what they're doing, right? And that's usually the process on our end. So I know that doesn't perfectly give you a way forward, but that's how we view it, at least as a VC.
Thank you.
Yeah. Always check out Empower Innovation, I think .net, and that's always a good way to connect with people on that. But I want to ask Sabya one question before we head out, and that is what startups in the Sacramento area are you excited about right now? As an investor, I know that's loaded.
Yeah. It's like how do you choose your favorite child, right? You have some awesome ones on the list here, and there's more on our website for sure. So there's a lot, and we've invested in a few. We've missed a few that are doing amazingly well, and we've captured a few that are doing really, really well, right? So I think of the ones you have listed on the screen right here, there's probably 1, 2, 3, 4, 5. I think 6, 7 of them are Sacramento based, all of which are doing incredibly well. So I'm not going to call out any of them on this call.
Yeah, there you go.
Better than the rest or not, right? But I will say none of them are not doing well.
Well, that's terrific. Well, we thank you very much for taking time with us, Sabya.
Yeah.
It was really very insightful, and I'm sure everybody got a lot out of that. So we all appreciate your insights. Wish you the best. Want to see more of your activities around here, and we'll keep an eye on that, Bears versus Longhorn questions, and see where we come out on that.
Sure.
So,
and just generally for anyone, right, that this is very, it's more macro advice. It's how VCs view things, etc. If you guys have very specific questions about your company or things like that, I mean, Thomas, if it's all right with you, if you guys could just direct them through someone in
Sure.
the CleanStart organization, and they can pass them along to me. I'm always happy to chat one-on-one, however it might be more helpful, because this is nice to know how VCs think about things, but it's not really helpful to be like, hey, what should I do next? So
right.
Feel free to do that, and I would love to respond and help you out there.
I appreciate the offer. Thank you very much. Okay, Thomas.
Thank you very much. Let's everyone give Sabya Das a round of applause for joining us today. I also want to highlight the Sacramento startup community. There's the Kings Capitalize event, which there is a clean tech company in there. So if you want to support clean tech in Sacramento, go to Kings Capitalize and vote for EV Life. They are a company that actually started out of a I want to say hackathon, but they're not hackathons. They're startup weekend. We started at a startup weekend here in Sacramento, and they have been growing. They've got the Cal Seed Award. They just talked at 1 million cups yesterday. Go and support clean tech in Sacramento by voting for them in the Kings Capitalize event. Thank you for attending. I also want to call attention to upcoming perspectives. We have epic funding from CEC and Lloyd Lobo. And connect with us on LinkedIn. Go follow us on LinkedIn, Facebook, Twitter. We're always putting things out there, ways for you to connect and learn about what's happening. Additional thanks to our overall program sponsors, Apaco Lab, Momentum, Reverent, Greenberg Traurig, and our community of partners. And thank you everyone for attending. And with that, we are going to end our day today. Thank you very much for joining us, Sabya. Have a good day.
See you at a future event. And
Yeah.
that's a great new hat, Thomas.